The wealth gap isn't what you think. It's a timing gap. Let us understand the meaning in decoded way. I want you to meet two people. Same age, same city, same state school, same graduation year, same entry-level salary of $42,000 at 23 years old. They even worked in the same industry for the first few years. If you'd met them both at 25, you genuinely could not have picked the winner. By age 50, one of them has a net worth of just over $800,000. Not life-changing rich, but the mortgage is mostly paid down, the retirement account is compounding quietly in the background, and they sleep without doing math. The other one has $58,000 saved. Combined, everything. The 401k they finally started at 34, the savings account that keeps getting raided when something breaks, and a home they refinanced twice. They're not broke. They're not irresponsible. They work hard, they earn a decent living, and they are genuinely mystified about where the gap came from. Here's what didn't cause it. It wasn't inheritance. Neither of them got meaningful family money. It wasn't income. They've earned within $15,000 of each other almost every year for 2 decades. It wasn't a lucky stock pick or a crypto windfall or a business that took off. It wasn't discipline, exactly, not in the way people mean when they say it smugly. It was 8 years. One of them started investing at 23. The other started at 31. Everything else, the amounts, the funds, the consistency, was roughly the same. 8 years is the entire explanation for a gap that looks, from the outside, like one person won at life and the other didn't. Now here's why I'm telling you this before I tell you anything else. Every week there is a new argument on television, in Congress, on your social media feed about the wealth gap. And that argument is real. The data on wealth concentration in this country is genuinely staggering, and we'll get to it. But there are actually 2 wealth gaps running simultaneously in America right now. One of them is between you and a billionaire, and there is very little you can personally do about it this afternoon. The other one is between you and the version of yourself that started 8 years earlier, and that gap is entirely, brutally, specifically about timing. That's the one destroying most people's retirements, and almost nobody is talking about it in terms that make it feel real. My name is Wick, and I spend an embarrassing amount of time.
The shape of the curve. Most people think of investing as something that grows steadily. You put money in, it goes up a little every year, and after a long time, you have more than you started with. Like a savings account, just better. That mental model is wrong, and the wrongness of it is costing people enormously. Compound growth doesn't move in a straight line. It moves in a curve. And the specific shape of that curve means that the early years of investing are almost invisible, and the late years are almost violent. Here's the actual math. You invest $5,000 a year starting at 22. 7% average annual return, which is a conservative estimate for a broad market index fund over long periods. In your first decade, you contribute $50,000 of your own money. By 32, your account has grown to roughly $69,000. You put in 50, you have 69. That's $19,000 in growth over 10 years. Feels modest. Feels like it's barely working. Watch what happens next. You never add another dollar. You just leave it. By 42, it's grown to about $136,000. By 52, it's about $267,000. By 62, it's around $525,000. You contributed $50,000 once, decades ago, and stopped. The account returned $475,000 while you did nothing. That's not magic. That's just what exponential curves do when you give them enough runway. Now, here's the comparison that should be tattooed somewhere visible. Person A invests $5,000 a year from age 22 to age 32, 10 years, then stops completely. Total personal contribution, $50,000. Person B invests $5,000 a year from age 32 to age 62, 30 years, never misses a year. Total personal contribution, $150,000. Same 7% return, same fund, different starting point. At 62, person A has approximately $525,000.
Person B, who contributed 3 times as much money over 3 times as many years, has approximately $472,000. Person A wins by $53,000, despite stopping 30 years earlier, despite contributing a third of the money. Read that again, because most people's brains resist it.
Why everyone knows this and nobody does it? Here's the uncomfortable part. This math is not new. It's been in every personal finance book since at least the 1970s. It is taught in high school economics classes in between chapters nobody reads. Financial advisors mention it at every onboarding meeting. And yet, the median retirement account balance in America for people aged 35 to 44 is about $45,000. For people 45 to 54, it's around $115,000. Those numbers sound okay until you run the math on what they need to be. At a 4% safe withdrawal rate, $115,000 generates $4,600 a year in retirement income. That's not a supplement. That's not enough to cover the electric bill and groceries simultaneously. So why does everyone know the early start matters, and almost nobody actually starts early? Let me give you the real reasons, because the usual answer, people are lazy or undisciplined, is not the answer. And the evidence for that is sitting right in front of us. The people who delay aren't lazy. They're working constantly. They delay because the obstacles are real. The psychology is working against them. And the financial services industry has done a genuinely impressive job of making the whole thing feel more complicated than it is. Here's what actually happens. At 22, you have the most powerful financial asset you will ever own: time. You also have the least money, the least job security, the most debt in the form of student loans, and the least clarity about what your life is going to look like in 5 years. The instruction to start investing now lands in the middle of all of that and gets filed behind rent, groceries, and the loan payment that starts in 6 months, whether you're ready or not. At 24, things stabilize slightly. Then the car breaks down, or the move happens, or the relationship changes the math. At 26, things are better. A raise landed. But now there's a conversation about maybe buying somewhere instead of renting, and you should probably save that down payment first before you do anything else. At 28, you're finally making real money, but the down payment isn't quite there, and actually you read that you should pay down the student loans before investing. Or was it the other way around? The internet has 17 opinions, and none of them agree. At 30, the house happens, and the wedding, or the baby, or both. Meet Daniel. Let me make this specific, because numbers alone don't keep you up at night. People do. Daniel is 34. He's not a cautionary tale. He's a project manager at a mid-sized company in Columbus, making $74,000 a year. He has a 401k he started at 32 with a 6% contribution rate. His employer matches 3%. His balance right now is $14,200. Daniel is not behind because he's irresponsible. He's behind because from 23 to 32, his student loans were $480 a month. His entry-level salary didn't stretch far enough to do everything, and the 401k always felt like the thing to handle after he got the rest sorted out. He never got the rest fully sorted out. Nobody does. That's not a character flaw. That's just life arriving in a continuous stream without pause. Here's what Daniel's math looks like right now. If he contributes 9%, including the match, from today until 65, investing in a broad index fund at a historical average of 7%, he'll retire with approximately $640,000. That's not nothing, but at a 4% withdrawal rate, it generates $25,600 a year. Social Security adds something, but $25,600 from investments for someone used to a $74,000 salary is a significant step down. Now run the same math from age 23. Same contribution rate, same return, same everything. The only variable is that he started 11 years earlier. Retirement balance at 65, approximately $1,420,000. At 4%, that's $56,800 a year from investments. More than double. Not because he contributed dramatically more. He contributed $44,000 more over 11 extra years.
The other $736,000 in the difference was produced by the curve, by the runway, by the years the money had to work before Daniel was paying attention. That $736,000 is the price of 11 years of delay, not $44,000, not the contributions he missed. The compounding those contributions would have triggered is the real cost, and that cost is almost never shown in the brochure.
The illusion of catching up. Here's where a lot of people arrive in their late 30s or early 40s. They've done the math, they've felt the gut punch, and they've decided they're going to make up for lost time by contributing more. This instinct is not wrong. Increasing contributions absolutely helps. But the math on catching up is far more brutal than most people realize. And I want to show you the actual numbers because the gap between what people believe and what the spreadsheet says is enormous. Let's say Daniel decides at 34 to really go for it. He maxes out his 401k. In 2024, the limit is $23,000 a year. He does this every single year until 65. 31 years of maximum contributions. Total personal contribution, $713,000. That is an extraordinary amount of money to invest over a working lifetime. Most people never get close to it. His balance at 65? Approximately $2,540,000. Now take person A from our earlier example, who simply started at 22 with $5,000 a year and kept going at the same rate, without ever maxing out. Never hustled, never caught up, just started early and stayed consistent. 31 years of $5,000 contributions starting at 22, total contribution, $200,000. Balance at 65, approximately $1,860,000. Daniel, with $713,000 in contributions over 31 aggressive years, ends up with $680,000 more than the person who contributed $200,000 starting early. So the aggressive late start does work better. Catching up is real and worth doing. But here's the comparison that should stop you cold. If Daniel had simply contributed $5,000 a year from 22 to 65, without ever aggressively catching up, without ever maxing out, just a quiet, boring, consistent $5,000 a year for 43 years, his balance would be approximately $1,860,000. He contributed $215,000 of his own money over 43 years. No heroes, no maxing out, no sacrifice. To beat that number with a late start, he has to contribute $713,000, more than 3 times as much of his own money, working significantly harder at it, to land in roughly the same place. The timing gap doesn't close. It gets more expensive to overcome with every passing year. The curve has already bent. The runway has already shortened. You can still get there, but you are now buying back years at full compounding price, and that price goes up every January.
The two wealth gaps? I want to stop here and address something directly, because this topic almost always collapses two very different conversations into one, and that collapse makes both conversations harder to have. Wealth inequality in America is real. The numbers are not subtle. The top 1% of households hold about 31% of all wealth in this country. The bottom 50% hold about 2.5%. The wealthiest 10% own more than 87% of all stocks. These aren't talking points from one side of the aisle. They're Federal Reserve data. And the mechanisms behind that concentration, inherited capital, asset appreciation outpacing wage growth, tax structures that favor investment income over earned income, access to financial products and networks that compound advantage from birth, those are real structural forces that individual behavior doesn't simply override. I'm not going to tell you that if you just start your Roth IRA at 22, the systemic wealth gap stops mattering. That would be dishonest, and you'd be right to close the tap. Here's what I am going to say. There are two wealth gaps, the macro gap and the personal gap. The macro gap is between you and a billionaire, and it is shaped primarily by systems that were built before you arrived. The personal gap is between you and the financially secure version of yourself, and it is shaped primarily by timing. These two conversations keep getting fused together in a way that makes the macro gap feel hopeless and makes the personal gap feel like a political statement when you bring it up. They're not the same conversation.
And refusing to address the personal gap because the macro gap exists is like refusing to put on your seatbelt because traffic fatalities are structurally influenced by road design. Both things are true. One of them you can do something about right now in the next 15 minutes. The timing gap is personal. It is within reach. And understanding it doesn't require you to have an opinion about tax policy.
Now, here's where the timing gap and the systemic wealth gap actually connect. Because the timing gap doesn't just operate within a single lifetime. It operates across generations. And this is the mechanism that turns a timing difference into a dynasty. Family A starts investing in the 1970s. Nothing dramatic. Index funds before they were cool, a modest amount every year, left alone through every crash, every correction, every terrifying headline. By the time their child is born, they have $180,000 invested. By the time that child turns 22, the account has grown to approximately $720,000 through compounding alone. They give their kid $50,000 to start adult life without debt and invest the rest. Family B starts investing in the mid-1980s. Similar income, similar habits, just started later. Same modest contributions. By the time their child is born, they have $40,000 invested. By the time that child turns 22, it's grown to $160,000. They help where they can, but there's no $50,000 to hand over. Both families did almost everything right. One of them started about 12 years earlier. The children of Family A enter adulthood without student debt, with a financial cushion, and with a mental model of investing as a normal thing families do. The children of Family B enter adulthood with loans, a thinner safety net, and the knowledge that money is something you worry about, rather than something you deploy. That's not a story about good values versus bad values. It's not a story about intelligence or work ethic. It's a timing gap that is now compounded across a generation and is reproducing itself in the next one. This is how wealth gaps that look insurmountable from the outside were actually built. Not in a single generation of extraordinary earning, in 2 or 3 generations of ordinary investing that started early enough to let the curve do its work. Now, here's where the timing gap and the systemic wealth gap actually connect. Because the timing gap doesn't just operate within a single lifetime. It operates across generations. And this is the mechanism that turns a timing difference into a dynasty. Family A starts investing in the 1970s. Nothing dramatic. Index funds before they were cool, a modest amount every year, left alone through every crash, every correction, every terrifying headline. By the time their child is born, they